Hey, well, welcome. Welcome, everyone. I really appreciate you coming. This is our seventh Michigan Investor Group meeting. We call it MIG sometimes. And just very grateful that you took time to come and, spend a couple hours with us. Less than a couple hours, I should be. Tonight, as I'm sure you're very well aware from the many emails received from me on this topic, we're going to be talking about this process, this concept with a funny name. It's just a name, but becoming your own banker and using something called high cash value whole life insurance to accomplish that. I know it's a lot of funny words, but it's a concept that I'm really glad you're going to spend a little bit of time, learning about. Our agenda tonight, I'll just run through this real quick. I'll mention where the restroom is, and then we'll talk about our next couple MIG meetings we have planned. I'll do a little introduction of how my family and I guess, became aware of this concept and analyzed it and decided to do it. And that, that'll be a kind of a casual story. And then I'll introduce our presenter, Gary. And then we're going to try something different. I'm going to kind of ask Gary a series of questions up here and, kind of go through the Q&A session between us. And then, like always, we'll have a open forum for question and answer afterwards. And I got a feeling a couple of us here are going to have some good questions tonight. And then afterwards, of course, you can hang out as long as you wish. We have a sign-up sheet if you want Gary to, contact you, get on his email list or whatever. There's a sign-up sheet in the back. All right. We should be wrapped up by 7:30, and if we're not and you need to leave, please leave. And please feel free to grab a sandwich or a water or anything while we're having our time together. Okay. Restroom. So when you came in the front lobby, you saw some signs for the restrooms. It's not that convenient from here, but basically it's like in that center block of is where the restrooms are. So it's kind of a little bit of a walk. Future MIG meetings. Nothing is set in stone, but I'd say the next 2 or 3 are going to be a presentation discussion about turnkey single-family house rentals. It's a process where there's groups that go out and they buy and renovate and then sell investors single-family houses, and they manage them also. It's a pretty popular thing happening right now, especially as the percent of renters in our nation rises versus owners. And then probably going to have a gold, silver, and precious metals night, which I honestly know nothing about, but I think it's probably worth getting a little bit of awareness in that arena. And then maybe down the road a bit, have a private equity group or fund talk about acquiring operating companies. That's a little different topic as well. And as soon as I have our October meeting planned, I'll get it out and get on our calendars and we'll go from there. Okay. So, any questions on that so far? No, we're good? Okay. So here at MIG, we've talked about quite a few kind of outside the box things. We've had a guy talk about ATMs, ATM machines. We had a group talk about self-storage units, mobile home parks, life settlements. And so tonight, we're going to talk about life insurance. So carrying on with some things that maybe we don't talk about a lot in our financial kind of realm. But we're not really going to talk about life insurance. We're going to talk about how to use life insurance, different ways of using life insurance. So not as a product, but as a vehicle and a process and a concept. So a couple years back, when it was about early 2017 when I think I was very fortunate. I was able to start spending a lot of time kind of like researching and learning about different investing concepts. And I'd hear about this thing, infinite banking concept, and become your own banker and bank on yourself. And I heard it and it sounded really weird, and I really didn't have that high of esteem of life insurance in general, honestly. And so I just didn't, I'd hear about it and I wouldn't research it, and I'd hear about it and I wouldn't research it. And then later that year, I chose to research this investment class called life settlements, where a life settlement, as some of you know, because you were here for our meeting a few months ago, it's where you actually buy someone else's existing policy, and then when they pass away, you get death benefit. Kind of creepy, kind of weird. But during that research, I learned a whole lot about life insurance companies. And I was like, wow. I was like, these things have been like the strongest, most stable entities in the United States for a long, long, long time. Like if you research the number of banks that fail versus the number of life insurance companies that fail, it's like 10, 20 to 1, maybe even higher. And now it's like, wow, this is really interesting. And I learned all about how because if you're going to buy someone's policy, you got to make sure that the life insurance company is going to, pay off when that person passes. And it's just the part of the vetting process. So I learned all about life insurance for a whole different reason than trying to buy life insurance. It was just a non-correlated wealth preservation, capital preservation investment vehicle. Life settlements, I mean. And so, and in that research, I learned how banks, sovereign wealth funds, pension funds, and huge entities buy these life settlements as investments that we never even hear of. And it's like, wow, they know something about this life insurance industry that I wasn't taught, and I think a lot of us were taught the opposite, to avoid it. So after that research, my eyes were kind of opened, and I decided to, I guess, again, I've been very blessed to be able to spend time researching these things because of our great Oberform team here, and so I decided I'm going to look into this infinite banking concept, this becoming your own banker concept. And so I started. And I started trying to figure out what the flaw was or what I was missing. And, I just kept learning more. I mean, you can see from those tables back there, I mean, those are all the books I've read on the topic, or probably more. And I've interviewed tons of people. And I was just like, wow, there's a different realm of whole life insurance than just buying death benefit. There's a whole different realm here that I was not aware of. So, all that said and done, with all of that to be said, probably after all that study and interviewing a lot of different people and getting pretty excited about it and learning about like how you can get control of your cash, while it's growing in a compounded fashion and it's not being taxed, and you can leverage it via loans, all these things. But I think what really stuck with me was the efficiency. It's this concept of doing multiple things with the same dollar. And I'm not going to try to, I say that comment somewhat tongue-in-cheek, but only marginally tongue-in-cheek. I truly believe via this process, you can use the same dollar and it can work for you in several different ways. So for example, I truly believe through all this that I can save my money by paying my premiums. So I'm going to pay premiums in whole life insurance. That's going to be my savings. That's my savings. And then that money, while it's in my savings, is going to grow tax-free and with uninterrupted compound growth. And I can access it via policy loans, and I can use it. And all this time, I still have the death benefit that'll provide for my loved ones in the event something happens to me. Now, I know I said a lot, but that's the concept that really grabbed me, was this efficiency. Like, I love like when, how it is, like, okay, well, I got to go to Myers, can I go to the ATM at the same time? Can I drop off this? And it's just nice when you have that efficiency, when you're killing multiple birds with one stone. And I think that was the angle of this whole concept that grabbed me. Now, there's a lot of different angles that grab other people. Like some people love the idea of, your cash is kind of hidden from creditors. It's the tax-free growth, the fact that there's a lot of different, the fact that you can leverage it, You can access it on demand. Like, it's not like you have to apply for it from a bank. You just get it. You just go get your money out of the life insurance policy and use it for whatever you want. Those are other reasons other people have, I think, choose to dive into this and learn about it. But for me, it was the doing multiple jobs with the same dollar. So, tonight's purpose. Tonight's purpose, in my opinion, is to create awareness. Awareness of this concept of becoming your own banker. Awareness of the fact that so much money flows through your life. Money flows in and it flows out. Well, I know this sounds really weird, and it took me a long time to really grasp this, but there's a way to capture that money and use it before it flows back out. And if you don't do it, it just flows out. But if you do it, you capture it. And I know that probably sounds really funky, but it's true. So tonight, hope to build a little bit of awareness that there's a way to capture some or most or all of the money before it flows out of your control. So, why did I bother you all with these 4 emails? I think people who come to me haven't gotten these before. I sent an email in end of July, preparation email 1, better way to save your money. Next week, email 2, how to actually realize uninterrupted compound growth. I mean, we're all taught that. We're all like, our dads and our grandpas are like, oh yeah, if you can double your money every day, you're going to have, but we're never given a vehicle to do it. Well, I believe this is a vehicle to do it. Number 3, where do a lot of banks, corporations, and high net worth people keep their cash reserves? Well, in this vehicle, in this process. And then 4, which was a few weeks ago, just talking about the versatility and the flexibility that comes along with having access to your cash. That a lot of other places we can put our savings or our investing, we don't have that flexibility and that access. So, and guess what? Nobody unsubscribed from those 4 weeks of emails. So, I sent all those emails because I feel so strongly about this concept. And I wanted to try to help some of you just start thinking about it and maybe prepare some challenging questions or start learning about it before the meeting tonight. And I think I said one thing in one of those emails was that if in these last 3 years, if there's only one thing I could have learned, I mean, I love mobile home parks. I love my settlements. I love multifamily. I love these things. They're awesome. I love cash flowing real estate. But if there's only one thing I could have learned in these past couple of years, it's this. This is it. Because this can be the foundation for someone's or some family's financial system, financial future. I know I'm probably sounding like a huge salesperson, but I'm not selling this stuff. I'm just trying to share it. So, all right. When we started MIG, I had this topic on my mind. I didn't know how we were going to do it because I couldn't even explain it. I still have a hard time explaining it. But when we started MIG, I'm like, man, I can't wait till we figure out how we're going to present, becoming your own banker with high cash value life insurance. But I thought, you know what, that's a little bit too out there. So we need to get some other things going first, build some credibility. So I think that's what's happened. And so here we are tonight. What does good look like? I'm almost done. So I'm almost done. As we discussed earlier, the goal for me is to create awareness, maybe a little interest. And to me, it'll be a huge win if a couple of you follow up with me with some questions, follow up with Gary with some questions. And if somebody wants to read a book or two, listen to this podcast, I think that'd be a huge win, in my opinion, as a result of our evening tonight. So, with that, how about we meet our guest? Gary Pinkerton. Okay, so Gary is a husband to Sue. He is a father to Jake and Ryan, his teenage sons. They live in New Jersey, and Gary was born and raised on a farm in southern Illinois, and from there went to the Naval Academy and retired after 25 years of serving in the U.S. Navy. I'm not sure how long, but most recently as a captain on a nuclear submarine. So Gary has some pretty neat, stories from those parts of his life. And then now Gary is a wealth strategist and life insurance advisor with Paradigm Life. Paradigm Life is a insurance advisory and financial advisory group. How Gary and I met. So I want to say this was late 2017. I just started getting the guts to ask some people that I respected, hey, have you ever heard about using life insurance for building your bank or taking loans? And this guy that I really respect, I was in his car and I asked him, and he just looked at me, he says, you got to call Gary Pinkerton at Paradigm Life. And I was like, so you're doing this? He's like, heck yeah, I'm doing it for 5 years. And I was like, okay. So that helped narrow down a person to contact, but it wasn't just Gary. I probably interviewed and grilled 5 to 6 different people kind of in Gary's position, and that's how I learned a lot of this, was seeing the different ways different life insurance advisors presented this and who oversold it and who was conservative and who was willing to take time. And here's what happened. All it was, when I talked to Gary, was me, $12,000 a year budget for life insurance. That was it. That's all it was. Well, then when I came back and when my brothers and my father and we decided we were going to work with Gary, I was like, oh, guess what? It's actually going to be 17 policies on me and all my siblings and all my parents' grandchildren. And I think you might have fallen off your chair.
I stand up, so I was good.
But but we selected them based on one modest policy and the service we received to get that started. So not to oversell anything, but just that's the background there. And even after we purchased it, Gary, after we made our first premium payment and now things are rolling, Gary has continued to be answer all our phone calls, answer all our questions, help us out with this and this. So that's Gary. You want to join me?
Yeah.
All right. Gary is from New Jersey. Yep.
Not my choice. I was on my submarine 8,000 miles away and got told that we live in New Jersey. That's how military families roll, I guess.
Okay, so this is a new thing, but
Can I make a couple?
Please.
So this is kind of just to allow this to happen in the background. So one of the books on the back there is from my advisor from 2011, now one of my best friends and a guy that I partner with, Patrick Donahoe at Paradigm Life. And I think the world of the guy. He gave me an opportunity to help participate in designing in writing his book. It took us about 4 years. But he wrote a book called Heads I Win, Tails You Lose. There's a copy back there. And I have set up something on my website where you can get a ebook copy of it and an Audible. I love the Audible because it's Patrick. Anytime the author is doing an Audible, I think it just brings a lot of value. This is somewhat unrelated, but I love the book Killing Sacred Cows because the Audible version, it's just an awesome book, but it's a lot of basic financial ideas. But in there, Garrett Gunderson, good friend of mine, high energy dude, reads that book, and it's worth it, even if you don't care about the subject, just to listen to Garrett. Back on the subject, this is an Audible and a ebook version of Patrick's book. If you would like one, theoretically you can hit the recycle after the last person and it will come back. But if it doesn't, it's just myname.com, GaryPinkerton.com/MIG on that. And then you want to just
we could put that in the follow-up email too.
Yeah, and they could do it later as well if you don't want to. That's half my computer, so it should stay alive for a while. And also, I want to pass around these. Carter, would you help me out with this? So, I don't know if you ever heard of the famous Little Red Book. This is like the prelude to The Secret, to all kinds of, the idea that you can think yourself into wealth if you just do some very simple Think and Grow Rich and things like that. This is 50 years before those. A simple little book you can read while you're waiting at a traffic light almost. If you do what's in this book, I promise you it's going to make some difference in your world. So I'd like you all to have one just for being here. And then last thing, Carter, if you another way to do some contact information, just talks a little bit about Paradigm. So just thought we could get these out of the way in the background. All right.
Absolutely.
No run to the back of the room. They're actually going to come to you.
All right. Sounds good.
All right.
Good deal.
Last
Good
part.
deal. Okay, so you want to tell us a little bit more about your background than I touched on?
Sure. So maybe some of the motivation side of things. So I grew up on a dairy farm in Southern Illinois, early 80s. Well, 70s and 80s. But early 80s, everything was coming to a head. We had two advisors that would always come to our house, once or twice a year. One was our banker. We loved when the banker came. And one was the life insurance guy, this old dude who smoked cigars in our house. And my sister and I loved when he came because he brought bunny bread Danishes, and because I think his family owned one. My mom and dad were super nervous when that guy would come, and eventually I asked my mom why that was, and she said because he's going to come and tell us that we need to spend more money, and I know he's right, and I'm going to end up writing a check that I don't have. And so there was this stress about the insurance guy coming, and there was this just euphoria when the banker guy came. And I didn't understand for like 20 years what was happening. And I don't think the banker understood either. But the banker would come, and we were in variable interest rate loans in the 1980s, which were 19%. And the interest alone was choking us. But he would always come, and he would have a solution to a little bit bigger loan, teaser rates, and it worked for a year or so, and then we got in trouble. And so we ended up losing the farm. Again, I don't think anyone in the 80s understood really what was going on, except for maybe the president. But that was challenging, and I didn't understand those lessons. It was ironic, actually, that my father passed a couple years later, and it was his life insurance policy that took my mom out of poverty for the first time in her life. And so I kind of had that also. So in the back of my mind, probably that was going on. I'm scared to death of being poor again, though, and so I stayed Navy for 26 years. I actually loved my time there, but I also loved having a paycheck and a pension that followed it. And as I was finishing up command, it was my last opportunity to be around a group of people, my own kind of small unit. I loved it. But I saw also that I was going to be kind of flying desks from that point forward. And I'd lost a lot of money in 2008. So it was my opportunity to kind of take back control. I got interested in investment real estate or single family, 1 to 4 family directly owned stuff. And I got real excited about that. And I found this life insurance thing as a unique way to fund my real estate. That's how I found it. And I kind of, somebody asked, somebody mentioned to me today, they said, hey, is there any way we can do it without the life insurance? I remember asking that exact same question. Yes, I would love to save my money in a tax-free environment with no life insurance. That'd be cool. Because at the time, I didn't respect the life insurance. My wife taught me a different way to respect that, and most of our spouses will do that for us guys as well at some point. But that's kind of how I ended up here, and then it started growing on me, and I started seeing the different aspects of it. And I decided to leave the Navy about 6 years early and go teach other people how to do this. Because fundamentally for me, I want the experiment, this 250-year-old experiment we have going in America that started the world on entrepreneurship and capitalism to keep going. So that's what drives me. That was a longer answer, I think, than a little bit more.
Thank you. You actually answered the next question.
Okay.
So we can jump on. And you answered the third question. How did you develop an interest in the bank on yourself concept? Sounds like from your real estate investing, you were exposed to it as a way to finance that.
And maybe what drives me and why I keep doing it is, I mentioned about the experiment, which is, people taking control of their own destiny. It was you, David, that was, my friend when I was driving over here, sorry. It's been quite a day. So I'm driving from the airport, and my friend who's not nearly as much into entrepreneurism as me told me about a movie that's by a pretty liberal individual on Netflix, and it would be better if I remember the name. Pursuit, I think. Pursuit. But it talks about a lot of statistics. The guy went out to prove that capitalism doesn't work, and he proved himself wrong. And it was compelling, the stuff that's in this movie about how capitalism brings out the best in people. It causes people to actually produce. And I believe that every one of us has some kind of unique genius inside us, and most of us don't share it. And it's because we're at a job that we just don't know how to stop doing to be able, so we're feeding the family is like the basic level. So it's my dream that we give people the confidence to go out there and actually, heck, if you're the best basket weaver on earth, you should share that with everyone else and not work at Walmart because you haven't figured out how to set the basic part of financial life in place. So that's really my big reason for doing this.
So now let's dive into this life insurance stuff. So what is your elevator pitch? Hopefully maybe in a minute or so.
Yeah.
Just elevator pitch of when someone asks you, what is becoming your own banker all about? You got a minute.
Yeah, so it is, it's a different place to store and grow your wealth. Everyone, if we're operating prudently, if we're being reasonable, we know that there are times where life gives us lemons, and when you get those lemons, whether it's time without a job or some big major expenses, 2 or 3 of them in a row, we need emergency savings. We need money sitting on the sideline. Obviously, if we're going to do investments, we need to save money for that as well. If our kids are going off to college like mine is this week, then you probably want to have saved a little cash, not in the market, so that you can't lose it and not have tuition. So there's places you want to save money. This offers an opportunity that the wealthy have been doing for 150 years to grow it without taxes, to have full access to it, and to do it at a much higher rate. So it's a different place to store and grow our wealth. It's not a crazy investment. It's not a loophole. It's just a much better way to do it.
Okay. So summarizing, it's a place to store your money, and maybe in a more efficient, tax advantage way, with a lot of other things that we'll get into.
Mm-hmm.
Okay. So let's talk about some of the specific factors that make high cash value whole life insurance the tool we use to incorporate the becoming your own banker process. These are some of the characteristics that they kind of sound too good to be true, and I probably mentioned them in some of my preparatory emails, and you mentioned a couple of them in your 60-second elevator pitch. But how about, I'm going to list these 4 things, and then let's talk about them each.
Okay.
So 4 to 5% tax-free growth, uninterrupted compound growth, full access and ability to use your money. So can we talk about each of those, how those are accomplished via this process? So 4 to 5% growth.
So an insurance company, I tend to really simplify things, and hopefully it is my goal that I don't make it so simple that it's not exciting enough to look into. That is definitely not my goal. But an insurance company's job in life with whole life insurance is to collect savings, collect premiums, they call them premiums, protect that money from loss, grow it both on a guaranteed increased amount each year. They credit dollars guaranteed minimum amounts. It's on the order of 1 to 2% after funding the insurance. So they're going to grow it, collect the dollars every year, grow it by 1 to 2% every year. And then they're going to, because it's a mutual insurance company that gives the profits back to the policyholders, there's no shareholders. So then they add dividends, if there is a dividend. There's been a dividend with all the companies I work with. Every year they've been in existence, so that's 130, 140, some of them 160 years. So Great Depression, banks are failing, over 80% of them. Life insurance companies are profitable and paying out profits. Same thing happened in all the world wars, 2000, 2008. So guaranteed increase and dividends, and you can access that without the impact of tax.
And how about the 4 to 5% though? Because that seems really high compared to like your savings account. So how does the 4 to 5% growth kind of factor in there?
So it's a combination of the 1 to 2%. So it seems like I'm being vague here. It's an actual specific amount of dollars that gets added, and you know it when you put the policy in place for the guaranteed side. The reason I'm saying 1 to 2 is because every year it's a little bit different based on your age. It's a programmed kind of transition. So it starts off 2% and goes down to like 1%. And then that plus the dividend. The dividend has been, historically the prime interest rate or savings account interest rates plus a couple of percent, 1 to 2% more. So if you think about today, when I say 4 to 5, it's a little less than half is guaranteed and the other part is dividend. In 1987, when we had 18% interest rates on our farms, then you could get 10% in a savings account and 12 or 13% in a life insurance policy. So it floats a couple of percent above a savings account.
Okay. How do we realize uninterrupted compound growth?
So you can get uninterrupted compound growth in anything. I think David said it earlier. Hey, our parents and grandparents tell us if you just let the money grow. The problem is we need to use that money at some point in our lives, right? So you could go to a bank and take all of your money and every time you get $1, put it in your savings account. And then you could go to the bank's loan desk and say, I'm going to pledge my savings account as collateral for borrowing your money. That's exactly what you do at a life insurance company. A I'll say it again pretty simply, right? So you walk into your bank, go and deposit your money, all of it, into this savings account, and then you go to their loan desk when you need money, you borrow theirs, pledge yours as collateral. You would not interrupt the compounding on yours if you did that. It's exactly what you do at a life insurance company. The problem is it doesn't make any sense to do that at a bank. You're going to earn 0.5% and pay 5 or 6, right? But if the numbers are different, then you can access the value of everything you've got in there without actually taking it out, so you don't interrupt it. So basically, uninterrupted compounding is just don't touch it. But we need to use the value of it.
I'm gonna add something here.
Yeah.
Like when it comes to, yeah, I guess you can get uninterrupted compound growth, but you usually can't get that with any kind of return.
Right, right.
But if I can get uninterrupted compound growth at 4 to 5% over time, that's very, very, very powerful. And that's the thing that caught my attention is another thing that caught my attention. How about the tax-free growth? Why is it? I know some people are going to say tax deferred, but if it goes until the person passes away, then it becomes a tax-free growth.
Mm-hmm.
So how do we realize tax-free growth? How does our cash value realize tax-free growth within life insurance?
So this is one of the things where my two awesome friends here in the front are also in the industry, and I think you guys would agree that this is the one thing you hear a lot about, that, hey, what if Congress takes that away? And I was just at one of the major companies that I work with, and I talked to the CFO, and in the front of the room, the president said, that is just not going to happen. We met with all members of Congress, and it's not likely that that's ever going to be taken to task. And the main reason is because they deal with life insurance the same way that the tax code deals with businesses. And what I mean by that is if you have a corporation, a C corporation, and you don't take the money out of the business, you don't get taxed on it. You can borrow against it, you can borrow the money, but you don't get taxed until you physically take the money out of the business. So what's happening in life insurance is that the dividends get reinvested in, the guaranteed growth gets put back into the business, and the contributions you put in go in there. And they grow and compound in there without any impact of taxes. If you shut the thing down or you take out the profits, you would get taxed on those. But there's a lot of reasons not to do that. It's very simple to have full access to it your whole life without actually taking it out. And when you do take money out, again, it's just like a business. If you make an owner contribution to your company to buy a cool laser cutting machine down there, and you've put that money in, then when you want to take capital back out of the business, the first money that comes out represents what you put in. I mean, the CPAs in the room can check me on this, but they're just treating it like a corporation. So bottom line is not likely to go away, and you didn't ask that question, but the tax-free growth of it is, it's really tax-advantaged growth because you can treat it in a way in which you get taxed on that money. Then you've basically turned it into a savings account, meaning when you took it out, you get taxed on.
Okay. Full access. You kind of touched on this, but another factor here is full access and the ability to use the money, the cash value.
Right, and so you could take out your own contributions, and that's the first money that comes out if you want to. But I promote, again, because of that uninterrupted compounding, I would just leave it in there and borrow against it. Now, sometimes in retirement, if somebody gets into this complete distribution mode where they're just spending down all their assets, maybe they want to distribute some of it. But I think, it depends on your tax rate at the time, but I think when you get to the point where all of your contributions are out and you got all your money back and there's nothing but profits in there, you'll probably just want to shift to loans and just borrow against it for the rest of your life, and it gets settled up when it passes to your children tax-free.
So this wasn't in my Q&A here, but there's so many things that we're talking about that I just want to I just want to talk about everything Gary's talking about for the next hour. Everything he says, I want to add another hour of discussion because I'm just saying that because I just encourage you if you leave here tonight with any interest, invest the next hour or two in the first Little Green Book, or invest the next hour with a call with Gary or I, or something, because it's just this is valuable stuff to learn about. What I wanted to say was, I forgot what I was going to say. Okay, and then plus, so you get this 4 to 5% growth. It's uninterrupted compound growth. It's tax-free growth. You can use your money, and you still have death benefit. So the whole point that we all think the insurance is there, we don't even care about it in this process, but it's still there. And I think as you own your policy longer and longer, and you get older and older, or if you have kids, or if you have grandkids, or if you have business, or if you have business partners, that death benefit will eventually become very important. But this process we're talking about, we want to buy like the absolute minimum amount of death benefit. We want it all going to cash value. But eventually, lives change, and that death benefit will become a very valuable aspect of this.
I've met a lot of people in their 20s and 30s that say what I was thinking when I was starting my policy, which is there any way I can do this with no life insurance? Or maybe I can put $1 towards the life insurance, right? And that's a common thing when you're indestructible, right? And not thinking that I'm the guy that's not actually going to die. Or maybe I don't have a family yet, right? But I have not met one person in their even 60s, but definitely 70s and 80s. They've walked through a lot of experiences in life, and everyone I've ever met has had someone they want to leave something to. So I just tell the people in their 20s and 30s, you don't get this yet, but there's going to be something, someone, some charity, somebody has touched your life, and you're going to want to give that money to them. So I really don't think that it's going to be a detractor in anyone's life that the life insurance death benefit's there. For me, it was a huge win. Do I have a minute?
Yeah.
2011, I started buying real estate. I've studied while I was on my deployment on my trip, and I've read everything I could find. Really excited about real estate. And we kind of in the background, I figured out a cool way to fund the down payments of my real estate. And I put the life insurance in place. I played the little game, but I pay no attention to my life insurance, really. 3 years later, I'm on house 4. I finished with 4. And I just put into contract on 5 and 6 and didn't bother to tell my wife yet. So we're out at an anniversary. I was going to surprise her. So anniversary dinner.
Happy anniversary.
And I'm like, honey, I just locked down our 5th and 6th properties. And she drops the fork from way up high, hits the china, everyone around us looks, and she's like, stop. You have to stop doing this. You have to slow down. I don't know anything about real estate. I don't know anything about all of these debts that you have going, and what happens if you die, and what am I going to do with all this stuff? And well, obviously I was quiet for a while, a little stunned, and thinking how such an idiot I was to do that on the anniversary. But eventually, around dessert time, I said, I was thinking one interesting thing about the way I funded these is that I have $2.5 million of life insurance on me, and there's like $1 million or so on you. And I really didn't do it for that purpose, but if I were to die tomorrow, like you said, you'd have $2.5 million of tax-free money that you could pay off the real estate and have $10,000 a month coming in because there was no more mortgage payment. Or you could just walk away from stop answering the phone and let them take the real estate. So you got options, right? And a couple minutes later, she was like, okay, tell me more about that. Like, what are you talking about? So she thought even less about the fact that I convinced her to get poked, like 4 years earlier and take some blood. But so the death benefit matters to our spouses, and that's me speaking to the guys.
So this next question.
Hey, can I just ask a question just to clarify, because that mechanism is so important.
That's where we're
So if
going.
you have $1 million policy, and you have $300,000 of cash value, and you borrowed $250,000 from it, right, against that cash value.
Yeah, if you died, it would only be $750.
Correct. So the point is that the $250 is a loan. That's why it's not taxable. You can take, any of us gets a loan from anything. We don't ever have to declare that on our tax return, except in, I guess, certain situations. Patrick could probably tell me. But that's why it's not taxable. But then if I die, I get $1 million minus the $250. My net debt benefit is $750. So is that right?
That's correct.
So
Yeah.
that's why it's a non-taxable. The loans from it are non-taxable, and you can keep taking loans to the extent you have cash value your entire life if you wanted to, right? I mean, as long as you have cash value, and just reduce the net death benefit that's paid out.
That's right. Awesome.
There's a phrase that one of the authors back there says, I'm borrowing money from my dead self. And I read that and I was like, I don't get this. And then it took me a while. And it's like, well, just what David just said. Because when, worst case scenario is you pass away, the insurance company isn't going to let you get more money than your death benefit. So that pays it back. So you don't got, I know I wasn't going to, there's a lot of things I'm not going to talk about tonight because there's just too much. But that was like, what does that mean? I'm borrowing money from my dead self. Well, would I rather use the money when I'm alive or would I rather have it used when I'm dead? Well, I'd rather use it when I'm alive. So I'll borrow it from my dead self. So, Jay,
Now, what's the difference between this and whole life, and maybe you'll get to this, David, I don't want to rush you, but I'm confused with whole life versus high cash value.
so this is whole life.
This is whole life.
Yep. And so then my next question is, what allows the whole life policy to act as a bank and build up cash value? Now we're gonna get into some of the mechanics of whole life insurance.
So basic whole life insurance was that thing where I said it's really simple. They collect premiums, add guarantees, add dividends, hopefully get it big enough so that it's bigger than the death benefit when you die, and pass it to your beneficiary, or pass it, to your beneficiary. And so that's basic whole life, ordinary whole life insurance. And so 1987, Congress has made one change in the history of America to whole life insurance. And they said back before 1987, wealthy individuals could write a check for $1 million, put $1 million into life insurance, no tax impact of doing that, and it would grow without the impact of taxes for the rest of their lives. And they would get the same benefits that you and I get on an average size policy. After 1987, they said, okay, listen, that's way too much money going into a policy. You know, they'd put $1 million into a policy that had like 1.2 million of life insurance. Like, that would be a crazy high premium for insurance. But what they were trying to do was save money in a tax-free environment. They weren't trying to get life insurance. So they cut back on that, what's called single premium life insurance ability. So you have to spread it in over 7 years or more to make it be more like life insurance and get the benefits of life insurance. So when we say that there has to be a few years, it's actually 7 minimum, that you have contributions going in. We can get creative and get around that, but basically 7 years. But then we came back and we said, well, you can put an attachment on this longer pay policy, which we know of as whole life nowadays, and that attachment is called paid up additions. And that's the single premium stuff we had before 1987 that they took away and we brought back. So as long as you have a normal little life insurance policy going, you can stuff a bunch of cash on top of it, and it's going to grow high cash value. So when we say high cash value, it's just got a rider attached to it called paid up additions, which means you can back the Brinks truck up and keep putting the cash in still, like we did before 87.
So like when I pay my insurance premium today, now, this much of it is going towards buying death benefit. This much. This is all going towards cash value. That's why it's a bank. If I bought a traditional whole life policy, all of this would be going toward death benefit. I want to minimize to the absolute legal limit the amount of death benefit I'm buying, and I want to maximize the cash value, because once I have cash value, now I can go back and use it and still have the death benefit, and still have tax-free growth, and still have uninterrupted compounding.
David,
Ken.
you get to direct how your money's getting used, whether it's going towards the cash value or the life death benefit portion, because it's paid up additions, or because normally you just pay your premium and they send it wherever they want. They tell you what goes into the cash account. You don't tell them what goes into the
Well, this one at the start, like you don't talk about how much. Like when I met with Gary and I went through this process, it's like, okay, how much cash can I put into this? That's the question. It's not how much death benefit can I buy. It's how much cash can I put in. And his job is to minimize that death benefit to the legal limit, so I can get all the cash access that I can.
And that's why it's so confusing to people, right? That's why people are like, never mind, don't talk to me about this anymore, because it's turning something on its head. I mean, imagine we're buying cars. I'm a huge car guy, car buff. So you're going out to shop around for cars. Like, what would you do if there's 5 Chevy dealers in the place and you want a Chevy Impala, right? You would go to each one and see who gives you the lowest price for the same vehicle, right? The value is the car, the detriment or the risk is how much I got to pay for it, right? And that's what most people think about for life insurance. Hey, I love you, John Hancock, but you're not giving me the price that Prudential's giving me. So lower your price or I'm going with Prudential, right? But now we're saying, hey, we want to stuff a bunch of cash into this tax-advantaged vehicle, and I don't want much life insurance. So it's like going to the car dealer and saying, hey, I like the Impala, I kind of like the showroom at the other place, but can I pay you more than I paid him? It's totally upside down, and it causes people to say, never mind, I don't want to talk about it.
Yeah, it did for me for months.
Yeah.
I mean, for months.
David,
Okay.
Is it important to say that the reason you want high cash value is that the cash value is what you can borrow against?
Yeah.
It's not the death benefit that you can borrow against. If you have $1 million policy, you can't borrow against $1 million because
Yep.
And so that's your savings account in effect, right?
Yep.
Yeah, and I would add to that, and that's awesome, David. And it's humbling because Dave and I went through this program, and he's teaching it. That's cool. I would also just add that that's important, but I would also put a timeline on it. It's most important in the first 4 or 5 years. I'll say less than 10 years. Mike and I were actually looking at a couple of policies, and there was one that was extremely high cash value in year one, but it lost out big time down the road. So there's always a trade-off, and if you get too accentuated in the very beginning, then it hurts the policy long-term, actually. But high cash value policies are a nice best of both worlds. After, I'll just be conservative and say after 10 years, the money that's going into the base, the insurance part, if you want to call it that, is adding to cash value just like the stuff going into paid up additions. It's all about those early years. That's what matters.
So, so when I first, again, I'm digressing here, but I actually had my dad come in 2 weeks ago, and I had like a 70-slide presentation. And I had charts, and I had paid up additions, and I had all these acronyms. What? And so at the end of it, we talked, and he's like, David, you convinced me and your brothers and a bunch of your friends to do this, and I didn't understand a third of what you just showed me. And so I'm assuming some of you in this room are like, man, get me to the details. Show me a chart. Show me an illustration. We're not going to do it tonight. We're not going to look at charts. We're not going to look at growth curves. We're not going to look at bars and charts of insurance policies. This is about just, if you get excited in it, if you get interested in it, then we'll dive into those details. But this is to just talk about the concept, because it is a concept. You're not buying a product. You're buying something that you're going to get advantage of it, you're going to have to use it. You're going to have to call up Penn Mutual and say, hey, send me $30,000 so I can go pay for my new roof or whatever. And then you're going to pay that back. And it sounds crazy, but that's what this is all about.
But on a one-on-one basis, I'll definitely go through the numbers and show you the math about why it works.
Okay. Can you please share a specific example of a client you have using the becoming your own banker process?
So I work with a lot of real estate investors. Is that okay to use a real estate example?
Yeah.
So I started off doing 1 to 4 family homes, and so I work with a lot of investors that do that. This works just as well if you're going to buy a house with cash. I don't think that's the most efficient thing, but it works if you're going to be participating in purchase of a company or a passive investor in an apartment building syndication, or buying your own business with it. So $100,000, just generic numbers, $100,000 rental house. What my investors typically do, they'll borrow $80,000, 80% from a conventional bank, and they'll put $20,000 in as a down payment. And there's closing costs, but I'll ignore that for the moment. And that $20,000, the average investor is just going to take that out of his checking account, put it in there, lock it in what I call house jail, and it's a success because they get cash flow from it, and the property appreciates, and the tenant pays the mortgage down, the tenant pays that 80% down. A lot of benefits with real estate, right? But as far as that $20,000 that they put in the house is not really all that useful. It kind of got stuck, and it didn't earn a lot on its own. So what I do and what I teach them to do is borrow the $20,000. So they borrow the 80% and they borrow the 20%. And if you're keeping track here, they have no money in it, and it can be an infinite return. It's a really good return if it's not infinite.
Borrowing 20% from?
From the insurance company, right? So I had the $20,000 in my life insurance policy. Rather than taking it out, I just borrowed the insurance company's money and allowed mine to do that uninterrupted compounding and growing. In that example, let's say, so I pay back my down payment money, my down payment loan from the insurance company. I just personally use the cash flow from the property and feed it back to them. I don't live on the cash flow right now. Totally could though. It's up to you. You're the banker. You decide when and how to pay back that portion. So let's just say that you're going to do it for 30 years. You're going to pay the banker back his 80%, and you're going to pay the insurance company back their 20%, same rate, 30 years. Let's say the current borrowing rates from insurance companies are 4.76 to 5% for just about all the ones I work with. So at 5%, on $20,000 over 30 years. That is, you pay back the $20,000 and you pay them $17,000 in interest. I think most of you who are doing 30-year kind of loans recognize that, especially if you listen to the 15-year versus 30-year guys, they're like, you're going to pay as much in interest as you pay in principal. Well, that's true at the 5% rate, 6% rate. So $17,000 in interest I paid the insurance company. At this point, somebody who's a buy term and invest the difference guy or a market guy raises his hand and says, exactly, that's why you use your own cash, because you paid $17,000 in interest back to that crooked insurance company, right? So, and that's true, you did. That's half the story. So the other half of the story is, what did my money do while it sat in the insurance company? So if you go get a savings account calculator and you just do the math, $20,000 growing for 30 years at only 4.5%, not the 5 that I paid them, right? Only at 4.5 is the 20 turns into $75,000, 30 years. Compounding is pretty powerful. So you take out the original 20, and the interest I earned in that 30 years was $55,000. I paid 17 for the opportunity to earn 55. Plus, I didn't have any money in the property. So if the tenant says, I got a cool lawyer and I'm going to sue you, and I would say, it's all yours, man, because the bank owns 80%, insurance company owns the other 20. Go for it. So there's a lot of other advantages, but just financially, putting your money in house jail, there's a cost to it. The opportunity cost in this case is 55 minus 17, $38,000. So I don't exactly do it exactly like that, but that gives you the idea. And here's the other thing, is that the velocity is much higher. So if I put my $20,000 in that property until I sell it, it's kind of there. It's stuck. I can refinance, but there's always going to be my money in there.
$20,000 cash from your wallet.
Yeah, from my wallet. If I put it right into the property, it's stuck there for the entire time that I own that property. And if I put it in the insurance policy and I borrow the insurance company's money, when I send $1,000 back to them, that frees up 1,000 of my 20, and now it's available to borrow again, right? So it increases the velocity of my money much faster. I pay mine back over 10 years, so every 10 years that money's back and I'm using it somewhere else. And I don't wait 10 years. As soon as it comes back, I use it. So does that help?
Yep. So you shared an example of a client, and then I was going to ask you how you're using it. I think you
That
kind
is how
of
I
did the
use it,
same,
yeah.
kind of did the same thing. Yes, sir.
Quick question, could that note from the insurance company, you said you quoted a market rate, could you say I want to have a note that's at 10% specified for your return?
Yeah, you absolutely can. And Nelson Nash kind of gets into that in his book. There's a whole different rabbit hole about the CPA world, and can you claim tax deduction for any of this, or can you claim a tax deduction for the extra part as well? I don't think it works personally. I don't think it works. I could get into details later, or the CPAs in here could, to charge extra. Now, there's a part of this that's kind of like tricking yourself. Like if you have trouble, Pamela Yellen's group talks about this a lot in a book called Bank on Yourself. And I love Pamela Yellen. I think she's a great lady. But I read her book, and I thought I could get rich buying BMWs. I really did.
Yeah.
But the point is that charging yourself a little bit extra interest is helpful for some people if they need to trick themselves into saving. Like my wife's like, I need to go to counseling not to save. So that is not my problem. But some people need to kind of.
This is another concept that, I just want to dive into this right now, but it won't work. It won't work.
Yeah.
There's this concept of there is a method where if you got your policy set up in a certain way, and your current lifestyle you couldn't afford to pay the full premium, pay the full base and the full paid up additions, but if you paid yourself back at a higher interest rate, you could then buy more of these paid up additions. But I know I'm just like glossing over your eyes, I'm sure, but it's totally legit and it's very powerful. It's just I don't think that's what we need to talk about tonight.
Yeah, in the end, you're
Come back tomorrow and we'll just come. Ken.
David, I'm getting stuck on, I think, a pretty simple thing that
Yep.
if I answer really quickly. So I've got $100,000 in my cash value account. Forget whatever the death benefit is, but I got $100,000 in combination of premiums and dividends and whatever, right? Okay. So I can borrow how much of that, and then when I'm using that money, how is my $100,000 still growing at 4%?
You can probably get 95,000 of it
Okay, so
via
there's a
policy
limit on
loan.
that, right?
Yep, and your 100,000 is growing as if you had no loan out.
And so I'm borrowing my money, or you keep saying you're borrowing?
You're borrowing the insurance company's money.
How is it their money?
You're just pledging it as collateral.
Okay, because my money's still.
It's kind of like Ken. Say you gave me $100.
Yeah.
I got $100 of your money in my pocket, and you come back and say, "Hey Dave, can I get a loan for 90?" Sure. Here's 90. I got your 100 right here. I'll give you a loan for 90.
Think about it as a home equity loan. You have $100,000 in equity in your home. They're gonna let you borrow $90,000 of that equity. You still own $100,000 of your home, but it's pledged as collateral. So if they ever have to collect on it, the insurance company is gonna collect on it, because they're.
When you die.
They're the ones, they know that. Now, they're not gonna let you not pay your premium, right? And so when that happens, you can create some issues, and they'll cancel your policy if you don't pay it up, because if your cash value drops below the amount that you have outstanding in your loan. But you're not borrowing your money, you're borrowing from the insurance company with their cash value as collateral.
So in the background, these insurance companies, I mean, they're financial institutions like banks. So they have book of business that is the life insurance policies that they're holding a lot of liquidity on, because somebody dies, they need to pay, be able to pay it out, right? And they also have other lines of business. They have casualty and property and things, and lots of them have assets under management. So all of the profits from that are also in their banking system. They just lend you their money, pledging yours as
So
collateral.
what kind of interest am I paying on their money?
5.
And I'm getting 4 on my money. So on that spread, that's why this is a good deal for insurance companies. They're happy to do this. 'Cause
No, actually, that's just a controlled behavior, believe it or not. So they're going to keep a little bit of a negative spread. So you're gonna earn slightly less than what they're paying. I'm sorry, what you're paying in interest. All right, where they make their money is their normal day job of lending it out to other people. So they lend out to major corporations. They're just a lender like banks. They can't do fractional reserve and a bunch of other. They don't lend to Joe's Burger Shop to open up a new restaurant. They're lending to Caterpillar, to General Electric, their Pulte Homes. They're trying to put money to work for decades, with companies that do things, staple things in the economy that have no history of defaulting.
And Ken, some of I can get what you're going there, and I think if you're only looking at it from that perspective, you're like, why would you ever do this? Why would you ever? If you're expecting 4 to 5% tax-free growth on your cash value, and you take a policy loan and you're expecting to pay 5% interest rate, why would you ever do that? Well, I think as you learn more about this, I think if you appreciate the terms, that you define the terms, you define when you can get that money, no form to fill out, no application to fill out, you determine how fast or how slow you pay it back. You have death benefit the whole time. But if you're just looking at it from that equation, it wouldn't make any sense.
Well, as long as I don't buy a car with it, the idea is that I'm gonna go invest in something that's gonna make more than 5%, right?
Yeah, so that my numbers were that
But you could also-
that earn 55 and pay 17. Remember that was me earning 4.5% and paying 5.
Because you're paying on a declining level. You're paying 5% as you make a payment. You're paying less and less and less over time, but your cash value is growing, compounding on itself the whole time.
Right.
You have a bigger number here that declines, you're paying interest on. You have a number here that's growing that you're earning interest on
Yeah.
over time.
I literally just did this with the policy that Gary put in place, and I called the bank, I have a line of credit on the house, and it was 4.74%. The insurance loan was 4.76%. I got the money in 4 days from filling out one form. One form signing my name, they didn't care what I was using it for, check showed up in the
Thanks, David.
Although they can wait like 6 months, right? Is that how the policies usually read? Like they don't have to give you your money right away. So. or do you-
True. That's a financial out. Never been exercised.
Okay.
Every bank says that too. By the way, it actually scared me when I read. I was going to use an online bank, and it said we have up to 6 months to give you our money, and I'm like, no, it's my money. And they said, no, we give you a receipt for the money. It's our money, and they said every bank says this. So I went and checked, and it does. So every financial institution out there does. Yeah.
Speaking of banks, don't banks often buy cash value life insurance as a tier 1 asset?
Yeah, bank-owned life insurance is Wells Fargo, I know it doesn't have the best reputation at the moment, but Wells Fargo has about $43 billion in bank-owned life insurance. And the background here is corporations do it too. Banks are the biggest at it. The main reason is because Federal Reserve requires them to hold 20% of their reserves as what they call Tier 1 capital. And in the industry, it's the strongest assets, and it's U.S. Treasuries and life insurance cash value. So they use it basically to fund executive pension systems. So they pay out the executive, and then when they die, it replenishes it and goes to the next.
So, how would you characterize the difference from, say, borrowing against a marketable security account, where one could argue that 4 or 5% you're getting on this cash value life policy is a lot less than what I could get on my margined marketable security account?
Yeah.
What are the intricacies there that?
If we could call them both a stable, liquid source of money to use as collateral, then I would say it's, maybe it's better on the marketable security. The challenge there, though, is that we just said, hey, let's compare borrowing money against an investment and borrowing money against a liquid safe asset, right? So this life insurance policy is replicating your savings account, your checking account, your CDs, right? And so the security over here is not that kind of an asset. And you'll see it when you try to borrow, right? They'll give you, 40%, 60%, something like that. And it can be called. And that's the part that would make me not sleep well at night. So I borrow against it, put it in a completely illiquid real estate project. And then the market corrects and Burns, Burns. I think I just combined two different names. But anyway, so the whoever my broker is calls me and they say, hey, we're calling on the loan, pay it off. I don't have any way to pay it off. I mean, it's an illiquid asset.
They call a loan because you might have been earning 17 and it went negative 15.
Yeah.
Right.
That's the difference.
Right. So they call loans due when your loan balance exceeds some safe margin.
And this is another one of these rabbit holes that we're not going to talk about, except for now. But I challenge you to go look up the last 25 years of S&P 500 returns and see what you would have gotten taxed, and compare that to 5% tax-free, with virtually no risk of, every year, every time you pay your next premium, it can't go down. I mean, just look it up. You're going to see it's like 6-7% maybe taxed. Last 20 years, S&P 500. So it's like, man, I just don't think it's worth it's not worth it, unless I'm a stock picker, which I'm not.
But most of us in here aren't. I tell people, listen, if you like the life insurance but you want your money in the market, borrow against your policy and put it in the market. And most of them are like, no, I'm going to do that, I might lose it. And I go, that's about the market. That's not about the policy. But most of us here aren't doing that, right? I mean, maybe we have some assets there, but we're also interested in mobile home parks and other things that, you're not going to borrow against that kind of an asset to do it.
Okay.
There's
Question,
my
Jeff.
project.
What if you're not particularly well-to-do? Do you have
Yeah.
a low cash value policy that works as well, or I mean, how much
I
do you
have
to get into this?
Yeah.
That's what a great thing about this topic is. I'll be honest. A lot of topics we've had at MIG, they've had a relatively high buy-in. This, $100 a month. I got policies on my 3 daughters, and they're $1,000 a year, $1,500 a year, and $2,000 a year, because they're different ages, and I wanted them all to have the same cash value when they're 18 years old. So I had to put more in my 7-year-olds now than I do my 2-year-olds. But that's the level they're at. And no, they're not going to be independently wealthy from that. But when they're 16 and buying the first car, if I've taught them, they're going to go take a policy loan. And then when they're 70, they're going to have a huge asset if I teach them right and they keep this thing going. It's a gift I can't give them down the road if I don't start it now.
So to build on that, Gary, kind of get into the strategy behind it. Say you're middle-aged, you're making a decent wage, but you've got debt. And obviously, term policies look very attractive based on death benefit versus the cost, the investment. So get into the nuances, kind of how you should be thinking strategy out. It's a tool in the box. and they can interplay together, and also from the retirement side too, as you think long-term.
Yeah, so I love term insurance. I've got both. I insure myself to, I forgot who I was talking to, I think it was Dan, and I said I buy as much insurance as I can get. And typically now it's term insurance because I have $100 and some thousand a year going into cash value life insurance. Like, it's more than I can handle. So I buy term insurance. I love both. I buy convertible term insurance so that I can turn it into a new little bank branch when I have the cash flow to make it happen.
Turn it into a new little bank branch.
Yeah. So I mean, what happens is you build a bank that's the size that fits your world, right? I mean, like if I'm going to go in and start a savings account at a bank at 17 years old, and I'm going to put $10 a month in, right? They probably wouldn't want to talk to me at, I don't even know the name of big banks, but some big marble thing that's 20 stories high in downtown New York City, right? It's not the right size bank. The vault is much bigger than I'll ever fill at that moment, right? So you build a bank that is the right size. You maximize the amount of cash going into the cash part. And if that's $2,000 a year, then that's what we put together. $500 a year would be going towards the base portion of the policy, and the rest would be going towards the cash side each year. If you come to me with a very large lump sum and no ability to pay on an annual basis, we can figure that out too. And so I actually like that part of this. It's like a puzzle. Every person's strategy is different, and that's why I work with 10 different insurance companies, by the way, too, because some of them just are not tailorable to what I want to do with a specific person, or some don't work in certain states. Think New York. There is a minimum for a given age, like that $500 a month I just said, or $500 a year I just said won't work middle age. I'm assuming middle age is like I'm 50, so somewhere around there, right? I'm just getting started, so I don't call it middle. But yeah, so getting into the specifics, we look at two things, right? I'll take a look at the amount of insurance you currently have and the amount of insurance I think you ought to have, and figure out what you think you ought to have. And we figure out the amount of insurance, but that's kind of the second part. I should have started with the first part. The first part is, how much do you want to save? What are you trying to achieve? What do you want to save for your family? And I show you something that saves that amount of money. And then we look at, there's a minimum and a maximum each year, going back to that MEC limit thing where you got to contribute for 7 years, right? So that base portion, that sets your minimum. And so I show it to you, and I said, hey, well, you said you wanted to save $1,000 a month. And so this has a $250 a month minimum and a $1,000 a month maximum. What's that? How's that feel for you? The $250, I'm a little nervous about that per month. Okay, so let's make it $100. So we make it the minimum so that that's comfortable, because it hurts me worse than it hurts you guys when we cancel business, because I just get black eyes for that. And eventually insurance companies, I guess, would get rid of me, but I have almost no default rate because I focus very heavily on starting small, going slow, a little bitty old bank branch, get used to it, and then we go for a bigger one later on. Once you come to me and you say, Gary, I'm very frustrated because by like a month into the year, my bank's full and I can't accept anymore. And I go, that's a horrible problem. Let's go build another bank down the street, right? So that's how we do it. And so as soon as we get the minimum right, then we look, hey, is the maximum big enough annually? Is it store what you want to do? Then the last step is, if we get those two right, then we say, okay, is it got enough insurance? Right now I've got $750,000 of insurance, and this is only $500. I don't think that's enough. Okay, well, you can just keep them both. Or we can add some term insurance to it and kind of convert it over. So I deal with the insurance part at the end, after we fix the savings and get the savings vehicle fixed. Is that kind of where you're headed?
Yeah.
Okay.
Well said.
Cash value accounts typically don't grow in the first, 3 to 5 years, depending on the policy. So is this a 3 to 5 year project before I've got money I can borrow?
So I'll tell you about my policy. I'm going to have, my policy is about $13,000 total premium, okay? And I've already taken policy loan. I only started it back in January. So I had about $7,000 to $8,000 cash value immediate access when I started it. So the first year, I'm getting about 60% of my premium is accessible via policy loans, okay? And then by year 3 or 4, I'm gonna have more cash value growth per year than I put into the policy. Then year 7 or 8, I'm gonna have more cash value total than I put in total. So I look at it as 3 to 4 years until you're marginally cash value growth is higher than your premium. And 7 or 8 years, your total cash value that you can use is greater than your premiums, total premiums put in. So it's not 3-year wait, it's 30-day wait. The people that I know will have a real estate deal. They, oh man, I don't have enough cash value in my policy. Go start a new policy. Pull it out in a month to fund their real estate deal. Because they know the power of having money work more than one way, working twice at the same time.
So is that doing like a paid up policy? How are you getting so much cash value available?
So remember the two components, there's the base part, the minimum, and then there's the paid up additions, right? So without adjusting it, you could have 60 to 65% available in year one. You can get it up as high as 90% available on day one of the policy if you really lean it out.
So there's people that they wait until they have something they want to invest in, they go start a new policy. Now, they could be limited by their lifetime like what's the limit of insurable value? Like I can't go out and get $100 million of insurance on myself. I'm not worth that much. I mean, I just can't. So you could hit a limit there. I can't afford it either. But they wouldn't give it to me even if I could afford it. Well, if I could afford it, they might give it to me. If I could. Okay, so this is going to dive into a specific issue here, but how about your federal student loan and grant application, the FAFSA? I know this topic might be relevant to some people in the room here. Is it true that life insurance holdings are not reported on the FAFSA?
Anyone done this lately? Filled in one of these? They're a dream. I did it this last spring. I had always heard that, and I think I might have said, that there's two kinds of, two primary kinds. There's FAFSA, which is 80% of them out there, and then the Ivy League schools are, I don't remember what it's called, it's like CAC something or other. And it's almost the exact same form. I don't know why they did two of them, because it's almost identical. I can't tell you now what the difference is, but I'd always heard that they're going to make you tell them how much you have in life insurance cash value, both you and the student, right? So the student fills out this painstaking thing that, who am I kidding? The parent fills out the thing for the student. And then you go back and you do all yours too. And it's a completely separate thing where you're talking about all your taxes and everything. But I did FAFSA. Cash value of the life insurance in general was not there. They have you do your tax return, and then you got to add in how much money did you get tax-free for your real estate? How much money did you get in grants for this thing? Like you're adding everything back in that you didn't have to pay taxes on, including your retirement accounts. And
like 401k, IRA, that hammers you.
And then,
but you can't get it.
But you can't get access. So the life insurance was not there, not mine, and nor was my son's life insurance on there. He had, almost all of his wealth, which is not a lot, but it was a year's worth of tuition or more, and didn't count.
So you fill this form out, you got all this money over here, the form doesn't even see it, and then you can use it to pay for your kid's school.
There are people in my industry that just do, there are dozens and dozens of people who do nothing but go to high schools, I guess, middle schools and high schools, and teach the upper middle class how to, not have that money exposed.
How to shield.
Yeah.
I hate to talk about tax avoidance, but it's just,
that's
our biggest expense.
David,
it's our biggest expense. Patrick taught me. I called Pat. I won't say it.
Like I brought my socks. We're patriotic here.
But my brother-in-law went through that recently, and now we know. It's like he went through it, and he's like, man, if I would have had this money in life and cash value, man, I would have, But if 401k, you can't use that money. But guess what? They want to see it. Why do they want to keep track of that? Well, anyway, this is another. Okay. So Dawkins is like, oh no. Why do you? Okay, I want to answer this question, but I'm going to ask you, Rusty. So Rusty and I, raise your hand, Rusty. We were in the car once going to look at the Lone Park, spent a great day together, and I had this weird phone call where I was kind of like, I'm not selling anything here, but this person's like, hey, I want you to talk to my son and my business partner and him and him and him. So I'm having this conference call, and Rusty's driving, at the end of that hour, Rusty was like, what was it like?
Really educated on this topic.
Okay,
I'm scared to know what this is.
why do you think most people don't hear about this concept?
Oh, I can't answer that without some kind of a conspiracy answer.
I can answer it.
I think, I believe it's, I always follow the money. When I'm trying to find an answer to something, I just see how the money's flowing. And because it drives incentives. And there's a tremendous amount of, how are Dave Ramsey and Susie Orman and why was A.L., I don't know if you know who A.L. Williams is. He's the guy who really made term insurance popular. In the late 60s and 70s, his company sold more term insurance than the rest of America combined. And the reason that happened is because there were some people on Wall Street looking for a way to grow their business, and they said, have you heard about this guy who's telling people to not put money in life insurance? And they said, I'm making all this up, but gosh, well, what do they do with the money when he has them buy term insurance? Maybe they give it to Wall Street, right? So if you look at who advertises on Dave Ramsey's show, and I think, listen, I don't mean to, he does a great service for a lot of people. They're just not in his audience. And many other people who are kind of on the financial radio entertainment shows, they're funded by Wall Street. So I think the answer to your question is because there's a whole lot of media focused the other direction. I think it's the same answer to why are we not going to have an independent guy reasonably run for a president, because there's a lot of money focusing on the other candidates. It's going to be drowned out. So I really think that's it about. And the other thing is that the people who know this works, who do hundreds of thousands of dollars in this direction, they're not people who get out there and talk about it, right? The wealthy families, multi-generational wealthy families that never got caught up in the bituminous defense of difference. They don't have 401ks. They just quietly go about doing what they know is right. Like, you've been to these family office meetings, right? I mean, or at least you've talked to people about that. They're not really out there. It's not in their best interest, I think, to really talk about this much. So middle class have gotten distracted. It's my goal to get us back on path. So it's a long battle, but I think it's because there's a lot of money marketing the other direction.
So can I share my thoughts on that?
Your conspiracy is different than mine?
I don't necessarily think it's a conspiracy. I think it just, things happen and we don't, and there's this saying that it takes a couple of generations to relearn what prior generations knew. And I'll try to make this real quick. So in the early 80s, this guy, Ted Benna, was trying to solve a single executive's tax issue. And he found IRS section 401-K. Hey, let's use this. It was used to solve to defer one executive's taxes. And then back then, people who were middle income, lower income, they weren't pouring money into mutual funds and buying stocks, and their employer wasn't taking their money out of their paycheck before they even started their job. Well, Wall Street was like, well, wow, we can use this 401k part of the tax code. That's not about retirement savings. It's just a deferred tax line in tax code. We can use this now to go get people to think they can defer their taxes. And companies can say, wow, I don't got to have pensions anymore. I can have my employees put their money away and invest it, and I can get out of the pension program. So you got Wall Street wanting access to middle class and lower class, yet companies wanting to get out of pension programs. It's a beautiful combination. And then from the baby boomers. Baby boomers are the biggest generation. Well, when were they making their money investing? From the 70s, 80s, and 90s. What did the stock market do? 70s, 80s, and 90s. Because all this money's coming in because of 401k. It's not because companies were performing better or they're making more dollars per share. It's because more money, more demand to buy those securities came into the market. And I got taught by my dad, you gotta get in the stock market. You gotta do this and this and this. That's all he knew. And we lost this whole generation of safety and security and savings. 401k IRAs are not savings, it's investing. But we're not taught that. If you're 22 years old, I'm at Chrysler, and someone says, hey David, think in the next 40 years, tax rates are gonna be higher or lower than they are now? Oh, they're gonna be way lower. Yeah, right, they're gonna be higher. So pay taxes today. Or if they said, hey David, you plan to be poor in 40 years? because then your tax rate might be lower. Well, I might be poor in 40 years, but I'm not planning on being poor. Well, then tax rates are going to be higher in 40 years. Hey, David, you think you might need to access any of your money in the next 40 years? Well, yeah, maybe I would. Hey, David, do you think the federal government is going to grade your qualified plan in the next 40 years? Well, it's a good chance they will. Well, no one asked me these questions when I was 22 years old, starting at Chrysler. If they would have showed me this, I would have been doing this, and I would have had 4 to 5% uninterrupted tax-free growth for the last 20 years. And that's way more powerful than riding the Wall Street train. Anyway. And then on top of that, this guy, when this guy sells me a high cash value life insurance policy, guess how much commission he gets on that compared to what he'd get if he sold me a traditional whole life? 30 to 40%. He has to spend more time getting his customers educated. Ask Kim, ask Jerome, ask Dave Hawkins, ask Derek, ask me, ask my dad, ask Kent. He has to spend a whole bunch of time educating his clients. Then he's got to spend a whole bunch of time after they're in it to help coach them and teach them and how to use it. And then he gets 30 to 40% in the commissions. That's a big reason why we don't hear about this. Because Joe Blow, insurance advisor, you go ask him about Nelson Nash. Go ask him about becoming your own banker, high cash value, infinite banking. They're going to, oh yeah, I know all about that. And then they're going to show you a traditional life insurance policy that they get 100% commission on, where he gets 30% commission. So that's why we haven't heard about this. Okay.
Thanks for not commenting.
I'm sorry. That was like a whole part of my presentation I gave my dad, and it's not about, see, this isn't about life insurance. It's about a whole different philosophy. And it just happens that there's this vehicle that has tax advantages and has security and has been around for longer than any of us, been around longer than the tax code, that we have been, I'm not going to say brainwashed, but we have a generation that just got sold qualified plans. I mean, I feel uncomfortable at Overform with our 401k. I'm like, gosh, when am I going to sit up here in our employee meeting and say, okay, guys, guess what? I stopped my 401k. I sold out my 401k because it's, but like, I'm not sure. Anyway.
You know, I think that there are people that are well suited with you know, those market-based assets.
And Dave Ramsey, if you're in debt and you're trying to climb out of trouble, Dave Ramsey, food, awesome. For savings, 401k, if you're making $8 an hour and this is all you're going to save, awesome. But I think the people who are here tonight, there's some better things that you can try to take advantage of.
Yeah.
So, okay. We're going to have our Q&A. I had one question. Is there anything that you especially want your sons to understand about money, finances, and investing?
Or daughter.
Or daughter.
Well, I just have 2 sons, though, so that was fair.
Sorry, Dina.
Yeah, it's just a medium of exchange. Money is nothing more than it's nothing more than demonstrating evidence. Excuse me. It's nothing more than evidence that you've added value in the world. So, you know, wealthy people are not greedy. Poor people are not stupid. It's just they haven't added the value, or they've added tremendous amounts of value. So, and the most important thing is that money is not the end goal. That's what I want to teach my kids. It's that we are our own #1 best asset. Patrick is great about that in the book that you guys signed up for. And he taught me that, and it was something that really, really resonated for me. And you're your own #1 asset during your working years, and your own #1 asset your entire life. So, you know, a pile of money, a business, a rental property, whatever it is, can never, ever keep you safe. And that's why people who have big piles of money still stare at the ticker symbol on the TV. My father-in-law had $6 million in 2001 because he was a Pfizer employee, and the stock went like quadrupled during the .com, and he walked out at the right exact perfect moment. And then a year later met a guy who took 5 of the 6 million, and he's been staring at the ticker ever since. And I can't tell him this because it's a little too emotional, but everyone who's got a pile of money and they think that pile of money is going to keep them safe because they're doing the 4% rule or whatever the heck they're using, that's just one mistake away from being in trouble. But if every day at age 60, 70, 80, 90, you know how to add value and somebody's going to compensate you for it, then you're never at risk. Like if I have wonderful clients who respond to me and use my services. So if I lose everything I've got, then I just go back to doing what I was doing, and I keep doing what I was doing. And the amount of money that I've piled up doesn't matter. That's what I want my kids to know. That was a longer answer, probably.
Okay, well, man, thank you for listening and participating in that. We had a lot of Q&A, but now we can have the real Q&A. And if anybody wants to leave, please, don't feel any pressure. But Mike.
Can you talk a little bit about transferring a policy to the next generation?
So, okay, so let's assume that the policy is on your own life, right? So you're the owner and insured. That's the easiest little scenario, right? And so because of 401ks and rollover IRAs and things like that, well, not rollover IRAs, but inherited IRAs, so we think of this concept of this separate entity that gets passed in some way to the next generation. What really happens with life insurance is it's a contract between the owner and the insurance company, and that contract's over when one of two things happens. The person dies, that's normally what happens, or the person hits the end of the contract. And today all policies written are age 121. So if you get to 121, they'll come to your birthday party and pay you the death benefit, and the contract's over. And that's actually started happening a lot because they used to be 100. And then the people were like, no, don't pay me this, because when they pay you, it's taxable in that year. So actually what the insurance companies now, this is kind of just Trivial Pursuit, but now the insurance companies have frozen the contracts. Well, they ask you, do you want us to freeze it, or do you want to pay a couple $100,000 in gains? So they freeze the contracts until and give you full access to them, and then they pay it out later. But rabbit hole. But my point was, it's over when the person dies. So you can't actually pass that forward. But what happens is this tax-free death benefit shows up. And I didn't say this to my kids, but another thing I would like to tell my kids is, if ever in your life tax-free money shows up, keep it that way. Put it in a tax-free environment, and that's life insurance again, right? So my goal is that when they receive the death benefit, my death benefit, they put it on the grandkids, the great-grandkids, etc. This is the Rockefeller way, by the way. Garrett Gunderson, a very good friend of mine, that I was talking about, Killing Sacred Cows book, he also wrote What Would the Rockefellers Do? And it's just a story about John D. Rockefeller's family. His family's ultra wealthy, six or seven generations later, and they're giving away hundreds of millions of dollars a year. The Carnegies.
But they're taught whenever someone passes and their life insurance is realized, that goes to buying life insurance on the grandkids and the great-grandkids.
Yeah.
And then the next person dies. That goes by life insurance, and then they're all taught how to use the cash value, not use the principal.
Yeah. So, but you haven't heard of the Vanderbilts or the Carnegies or descendants of that family. But you can meet a Rockefeller any day you walking around New York City. So why is that? It's because they've protected their wealth from the two biggest risks to multi-generational family wealth, and that's taxes and family members. So they taught the family members, how to protect it and respect it.
So Mike, were you talking if your dad had a policy on your life?
I was asking about a friend.
Go ahead.
So if you bought a policy on Mike's life, you could pass that to Mike.
Yeah.
Mike could become the owner of it, and what happens there?
Then it just continues on. You're the new owner. You can write the blank check, and you pass over all rights, absolutely every right to him. So while you're still the owner and he's the insured, he's just the thing we calculated the math on, right? And the person that triggers the payout someday into the future. But other than that, you're not a player at all. Ken, you're the owner. You can change beneficiary. You can take loans. You can make contributions. You can take withdrawals. You can shut it down. You can hand it to some stranger going down the street. You're the owner. You have full access. When you transfer to him, then he's got full access.
So my daughters are going to get a policy when they're 18 or 26 years old sometime that is going to cost them $1,000 a year. That's going to be super high performance for the rest of their life, because I've seeded it from age 1 to 18 or age 1 to 26. I mean, it's going to be a super high performing asset that's going to be the first. I'm already there. My wife and I, our life now is like, okay, we gotta pay our life insurance premium because we know this is gonna perform.
Please.
Ben,
What's the best critique of the concept that you've heard, of the infinite banking concept?
What's the best,
best-
argument against it?
Yeah, or critique you've heard, or even just a concern that you've heard about it. And maybe related to that, is there anyone to whom you would not recommend the process?
That's a great question. You have the who it's not good for on your little, you don't have it on?
I mean, I would answer that saying someone who's undisciplined, someone who doesn't have free cash flow, someone who can't make commitment for 5, 7, 10 years, don't get this started. Okay? Like that's the kind of people that shouldn't, or people who are unhealthy, or if the insurance company, if you're not healthy, they don't give you insurance. Those are the reasons I would say if you're undisciplined, if you don't have any free cash flow, if you can't live below your means, or you can't spend less than you make, those are the reasons that you wouldn't want to start this.
I would caveat the undisciplined one. If there's a kind of person who just needs a little bit of accountability, they just need a little bit of a nudge, this is a great way to be a forced savings plan because it's a savings account that shows up like a bill,
But you still got to be disciplined to do that.
You do. You have the ability to cancel it, yeah. But you have to have a little discipline. But if all you need is a little push, then this might be that push. It's just a little bit more challenging to get access to the money than it is from your savings account.
But let's say you're afraid about starting policy because you've heard that, man, if I can't make this premium, it's all down the drain. Well, there's a lot of options. I mean, you can, I mean, I don't want to go into no details, but there's options. You don't just lose your policy. There's options. And if you have
And in fact, they all have self-protection mechanisms built in now. So if you fund the policy for a couple years and then get lost in the South Pacific and just enjoying life or something and forget totally about it and no one can contact you, it will protect itself as long as it possibly can. And when it goes away, has completely exhausted the cash value a few years down the road. So I have trouble, obviously I've drank a lot of Kool-Aid here, so I have trouble finding who it's not good for. People be like, well, what if this doesn't play out the way I expect? And I go, absolutely. Like if you decide to quit in 5 years, it was a bad idea. And they say, well, what? I mean, I'm not a quitter, so let's come up with another scenario. I'm like, all right, well, if you die, it's not good for the family, but financially, that was like hitting a lottery, right? You put a couple years worth of premiums in, and you make $1 million, right? That's not the problem. So it's just hard for me to come up with that answer. Other than that, I helped you put in place something that won't work long term, or some major life event happen. And what's the worst case for that to happen? At the end of year 2, technically, is the absolute worst time for that to happen. And the way I design them, the worst case, you're out 25%. Absolute worst case. I've got 2 hands full. I couldn't carry them in 2 hands, the number of other investments that I've lost that like that.
Other reason to be Ben is that you got to make sure your advisor knows what he or she is doing. I've heard horror stories, people who thought they were getting this started, and someone gave them an IUL contract, or someone, so that's the hard part too, is if you pulled the phone book out and you called 20 whole life insurance advisors, it's a good chance none of them know how to do this. There's a good chance.
Or will do it.
You just mentioned the word IUL. What are the pros and cons of that there? What is IUL?
So, yeah, universal life insurance came about, so term insurance came around, and then universal life came out. And universal was created in the 70s and 80s, high interest rate period of time. Whole life insurance companies weren't keeping up with the trend, and so people wanted an ability to adjust the policy. So you can, within a universal life, it's a term insurance policy that has a rising premium at the end, and it has a savings account attached to it. You can treat a universal life insurance policy well. You can also mistreat a universal life insurance policy. All the protection, a lot of the risk is pushed back or pulled back on you. So a very simple way to say it is that term insurance is a very pure way of pushing a lot of risk at a low cost to the insurance company. It's not likely I'm going to die tomorrow, but I've just pushed it to you, Mr. Insurance Company, for $500 a year. The risk is now on you. If it happens and I retain the risk, I'm devastated. If it happens and you got the risk, you got millions of people, you'll just pay this one freak accident out and you'll be fine. So a whole life insurance does something similar to that. pushes all the risk. They have all kinds of cool guarantees in there. Premiums can't go up. Your insurance costs can't go up.
Whole life pushes all the risk to the insurance company.
Yep, term and whole life
Yep.
push all the risk to the insurance company. It's just that term is not a long-term thing, and it's not a savings vehicle. They tried to add a savings vehicle to term insurance and give you all these options. Well, what happens when people have free reign to lots of collateral and capital and ability to adjust things? They destroy it. So most people will start with universal life insurance policies that are underfunded, or they'll borrow against it too heavily. And every time you do one of those things, like borrowing against a universal life insurance policy, removes the requirement from the insurance company to keep the thing in force or to keep the premiums from going up. That's what I'm advocating, is borrowing against a policy. So there are people out there who use the universal life insurance like this, and they don't tell their clients, what I'm telling you to go use this for removes all of the requirements. I mean, removes all of the guarantees to it. But it does, every one of them. That's why we don't use it. Treated correctly, it could be a great vehicle. It could perform as well as whole life if it's treated right.
Gary, you made a statement that if you start with a small policy and you build enough cash value, just go start another one. Why not just increase the current policy?
Sometimes that will work. It depends on the insurance company. It depends on your situation. But even if it does work, it's the exact same amount of effort as just going and getting another one. And typically what I see is that, and this is played out in my life as well, is that rather than just getting another one on myself, I have a better reason to get a policy on my wife or my children, to start little banks for them, more for the education process than anything else, or to use a different insurance company. So I mentioned before I work with 10 companies because they have a little bit different unique benefits of them. So again, back to my car guy analogies, right? Like my perfect home in Florida when we move to Florida is going to have 7-car garage, and they're all going to be mine, and there's going to be a sedan and a sports car and a pickup truck and, I don't know, SUV, and I will use that specific one for its unique purpose. So if I personally own insurance policies from American United Life, Penn Mutual, Mass Mutual, New York Life. Why do I have 4? Well, some of that's because I want to walk the walk before I use it for my clients, but also I really appreciate the benefits of each one and being able to accentuate those benefits. I use one policy, I borrow against one policy when it fits best to do that. Does that help?
Mm-hmm.
But
So-
another reason is, Brad, if you had a policy when you were 40, the insurance company isn't just going to just give you that same thing again when you're 45. They want to make sure you're still the same health. So they're going to make you go through the underwriting again, because you could have gotten cancer in those 5 years. And like, hey, bump up my policy. I'm going to die sooner.
Yes, that's what I meant. It's the same level of
They're gonna-
work. So you got to go through the underwriting, everything you would do to get that other policy. You got to do that to increase yours, because it's increasing risk to the insurance company, right?
Sure.
You want to talk about somebody who's motivated to get insurance? It's a guy who just had a health issue, right? That's called
Adverse selection.
Yeah, good job.
Could you compare and contrast just quickly, so like in David's situation, taking out a policy on himself versus he's now taking out policies on his children. So what are the benefits, pros and cons, just quickly, or differences between those two aspects?
Yeah. So from the cash value banking side of it, to me, it's just different bank branches. They'll perform a little bit different. Really, I would say, this is really generic, but late 30s to, let me go, 10-year-old to late 30s, they're pretty similar as far as performance. Outside of those windows, they perform poorer. Believe it or not, younger children is a little bit worse than, and as is 40 and older, but it's not substantial. It's really not that big a deal. It's a small fraction difference. 70-year-old, 80-year-old, it still makes sense in most cases to do it, to store your money or store your cash here. So from the cash banking side, they're just different policies. There's some nuances, like I'm challenged to put $15,000 a year into a 1-year-old's policy, because that's $5 million of life insurance, and the insurance company looks at me and said, who's going to be out $5 million if this baby dies, right? So it's just really hard to get that amount of insurance.
Human life.
Right, the human life value aspect of it, right? So cash values on the cash side, not a big deal. On the death benefit side, different things happen, right? Because what triggers the payout? So I had a client who wanted to put insurance on on the minor children, and one minor child was not insurable. So I made the recommendation, I still think it was a decent recommendation, just put an equal amount of money on mom for that child, and you know, so you're still contributing to each child. But on the death benefit side, it's not quite that simple, because assuming these children outlive their parents, that one child is going to get a payout when mom passes, right? So it's a little bit different because what triggers the death benefit thing. But on the cash value side, on the infinite banking side, very, very little difference. You're owner of the minor child's policy. So as we were talking about, you know, over here, it's like you got a policy on yourself. I have people who buy policies on their spouses. Why? The spouse doesn't want to deal with all the insurance trading stuff, or you know, the interaction with the company. That's fine. Works fine.
Kind of compounding off his question, so let's say Dave did a policy for like $13,000 a year. Would it be better to do it for his kids because they're cheaper, because underwriting is cheaper for younger kids, 10 to 12, and then?
Again, it's really pretty similar. It's not a big difference. What I always, if David had a lot of insurance on himself, like he's covered pretty good with life insurance, then yeah, I'm happy to do one on the kids, you know, instead of one on the parents. But and the insurance companies actually won't support me in this. If I say, hey, my 50-year-old who's overweight, this is not David, my 50-year-old who's overweight.
42 overweight.
He would like to put insurance on his 12-year-old child. Well, he doesn't have any insurance on him, and he's the primary breadwinner. Why would we do that? Well, because he's going to grow more money there, right? So the insurance companies, they're pretty solid individuals. They're going to say, no, that's imprudent. Get insurance on him, and then come talk to us. Yeah.
Because the banking aspect of this is what we're all about, and not death
Yeah.
benefit. Does it matter, how much then does it matter about how I get rated?
Not as much as you think.
Yeah, just as long as I get in is good.
Standard and above, standard and higher than standard, improved, performed, preferred, whatever, it's almost identical. What you will see is a lower death benefit, but the cash value performance is pretty
So this is
similar.
about cash the
Yeah.
cash availability.
Yep.
Any other questions? Or and remember, please feel free if you want to leave. No pressure. Matt.
You may have alluded to this, but it was unclear. Is there a way to get other protected assets rolled into a program like this? I mean, you had briefly mentioned your 401k, and that's what I'm referring to,
Yeah.
the retirement plan. If you,
This is a general statement.
Yeah.
In general, you want to use after-tax money to fund life insurance, similar to a Roth, because it's tax-free coming out, right? You can do pre-tax, but I think that's a big mistake, long-term. Yeah. And so if is that what you meant, we're rolling assets over?
Yeah, I meant, you know, if I had a significant asset in a retirement account, but yeah, you know, it's got more volatility, is it?
Yeah, we flow it in over time. We flow it in over time, and there's some really interesting options. You want to
Well, I think things are going really well. I think we should wrap it up. And but feel free to hang out and see me or see Gary. And thank you so much for the attention and for coming. Thank you.